Hi everybody, Robschild here. Today is Thursday, June 26, 2025. Today's episode begins with our headline, Jobless claims go parabolic as stocks hammer all-time highs. Everyone was curious if we would get to all-time highs in the S&P 500, and today we did it. Now the question remains, are we going to head higher, or is there going to be enough resistance in the call wall, as they call it, to send the market back down lower? And while stocks are, in my opinion, getting ahead of themselves, initial jobless claims, didn't seem that bad, only 236,000. But the one that slips under everybody's radar often, I find, is the continuing jobless claims, surprising the market to the upside. And when you look at this on a chart, this is not a higher high, higher low kind of situation. This appears for the moment to be a parabolic rise as seen on the right side of this chart. If this continues in this pattern of going higher at a faster and faster rate, you can bet your last dime that the recession is beginning now. With that said, you can have a pattern appear to look that way before reversing to the downside, like in 1986, where it looked like we were getting steeper and steeper at a faster rate before rolling over straight back down to the downside. Another part of this is that overall, only 2 million continued claims is relatively pretty low for historic standards. And then again, the dot-com bust, we went from, 1.9 million and rose only to just below 4 million. And so sometimes the rise during a recession is not as bad as other times, like in the Great Financial Crisis when we peaked out at 6.6 million. You can see it better this way. Anyway, you look at it, right now, as it stands, this looks like a parabolic move to the upside, all while stocks are knocking on all-time highs. Now, if that's not complacency, I don't know what is. Adding to the complacent state of the stock market, Q1 GDP was revised lower today in the final revision from the previous negative 0.2% to a negative 0.5%. Very solidly negative. No question that GDP is indeed negative. I found some interesting things in charts today. We'll get there when we get there in a moment. Before then, community topics. I wanted to do a poll today in the comment section. Recession, depression, or soft landing over the next 12 months? What do you guys think? Comment below. Don't forget, coming up tomorrow, we have PCE data coming out with the inflation data. Remember, low inflation isn't always actually a good thing. It could actually mean a bad thing eventually. Markets, when economies are getting bad, disinflation, deflation especially, is not always seen as a good thing. We'll see what the numbers are and how the market reacts tomorrow. We also, of course, have tariff updates. Finally, tariffs are coming back into the conversation in mainstream news. Also, federal budget updates. Thank you for watching, subscribing, commenting, and supporting. Your views, subscriptions, comments, and support is greatly appreciated. No changes to my daily reminders macro views. See my website to read them. And no changes to the crystal ball readings nor the Robschild portfolio. Onto the charts. I'm going to start with the S&P 500 again. Remember, we are closing at all-time highs today, essentially. It would be typical for institutions to try to poke above this to sort of stop people out of shorts before, of course, getting bearish. That can be something very typical. What we might end up seeing is this blue line here. We could reach up and hit it tomorrow, for example, and then close below the all-time high closing line. That would be a scenario easy to imagine. TLT, my favorite place to be. I mentioned yesterday that it looks like that TLT and the S&P 500 have been starting to look like we're entering a correlated state. In other words, the S&P 500 getting bullish with Treasury bonds. And very notably, for me anyway, we broke out of this ascending channel. I've been saying show after show, this is normally a very bearish setup. We have obviously a flagpole going down in consolidation in an angle that looks very, very much like a bear flag, and normally we would break down to the downside, and we did end up breaking out to the upside. Now, in order for this to really continue to get bullish, we need to see a close above today's wick. So today being the high being 87.95, we need to see a close above that tomorrow, and if that happens, then yeah, TLT will be rising significantly pretty quickly, as there's not a lot of psychological points holding it down from there. And then taking a look at the 10-year Treasury note yield, adding to the bullishness of Treasury bonds. I mentioned yesterday how incredible it was to have the low of Monday match the low and close of Tuesday and the low and close of Wednesday. 3 days in a low, refusing to drop below. It was 4.29% in the 10-year Treasury note yield. Today we dropped significantly lower on a chart basis and closed lower with a red candle. This is very bearish on the 10-year Treasury note yield, and I'm hearing professionals see this pivot point be a potential support line at 4.13. The target of the head and shoulders for me is around 4.04, and then there's another longer term trend line that could get us down closer to 4%. It appears to me that the 10-year Treasury note yield is absolutely collapsing here. This is very bullish for TLT. Go TLT. With yields dropping and bullish sentiment across markets, it's no surprise to see HYG, a junk bond fund, rise. And when you divide it by SHI to try to look at where credit spreads are going, we tightened even further today. Let me scroll in a little bit further. This is HYG divided by SHI going up today, and this is after yesterday's already very tight junk bond credit spreads of 3.04%. So we're very likely below 3% now on junk bond credit spreads, which is a huge alarm bell for me. That's like complacency. The market is just getting way out of hand, way, too far in the euphoric stage. I do not believe it will last very long. So with risk on and the S&P 500 rising, I sometimes like to take a look at TIP divided by EIF. This can represent basically where the break-evens are going to be around the 6-year, 7-year. When stocks go up, sometimes that can be like, okay, inflation expectations are also going to be floating up, and they're not. They went down a little bit today. That'll be confirmed in the Fred tomorrow. That doesn't update until a day later. Actually, I think that updates at 5. It's not 5 yet, but point is, inflation expectations dropped a little today. I won't get into the depths of how everything correlates with everything, but the DXY did break to the downside today, notably below that level I've been talking about on our show that Ira Epstein brought up, 97.68. We jumped over it and went down. So the dollar is looking very bearish. Most traders are looking for it to continue quite a bit lower before we get any psychological before we get any traders willing to step in and send the dollar back up. So the dollar is, we're in free fall mode in the dollar right now, it looks like. Next chart that really caught my eye today was copper. I have been talking about us coiling up so tightly here, and 3 levels of confluence preventing Dr. Copper from going higher. I said yesterday I am expecting Dr. Copper to drop pretty strongly from there, and it didn't. It's a good thing I'm not a day trader by trade at the moment, not yet. because I probably would have shorted copper yesterday if I was more aggressive, and it would have gone against me hugely. But this is something institutions will do to try to knock people out of the trade before going lower. In order for copper to really get more bullish, you got to see a closing candle. In other words, by the end of the day tomorrow, we need to see it go above today's high, which was $5.15 a pound on copper. This could end up not being a breakout, but being a fake out. And if it ends up being a fake out, we could see copper drop really hard from here. And to be honest, I suspect that is what's going on here, but it's just a guess. Two other charts that I wanted to point out today. One of them, SMH. Sorry if my screen is blocking some of the charts some of the time, but anyway, we went up in a pattern that's sort of looks like an exhausting move. You can see that instead of accelerating to the upside, we're slowing down to the upside with smaller, weaker green candles. So the momentum we're losing momentum. And with a move this sharp to the upside, it's very overbought. So it would make more sense for this to reverse to the downside. However, we haven't gotten back up to the all-time highs like we have in the triple Qs and the S&P 500. Again, a lot of people like to say follow the semis. Sorry, I'm blocking the chart there. So if we're gonna follow the semis and say, okay, well, it's a lower high, it could be a sign that things are reversing. The last chart of the day I want to bring up is triple Qs, the NASDAQ. Although we have a confirming candle above the all-time high, which is sort of bullish, there's a pretty solid trend line from the top of December 2024 to February of 2025 connecting. We crossed through that line today. In order for traders to believe that the triple Qs is continuing higher, we'll want to see a close above today's wick. So a close above 546.22 and QQQ to confirm that, maybe we actually, believe it or not, do have more legs to the upside. I don't know about you, but I am getting a lot of vertigo from the U.S. stock markets at this time. So that's all for today's show. Hope you enjoyed. Thank you for watching and see you next time. Robschild.